If you think about the drop we just had, and we thought there would be a very dramatic upside in the metals. And I don't mean what we saw up into January. That wasn't the dramatic upside. I think we're going to go a lot higher.
Yeah, like 300 to 500 for silver.
300 to 500 silver is probably minimal, and gold well over 8,000. I'll remind me to come back to that issue, the 8,000. Yep. But the drop, we expected a sharp drop in the middle of this massive move that we expect to see. And we got one, but it came faster than we thought it would occur and a bit earlier than we thought.
Precious metals are standing on the brink of an unprecedented market transformation as global economic volatility accelerates. Short-term price consolidations are not signals of exhaustion, but rather the foundation for a historic breakout across tangible assets. Michaeloliver, a renowned technical momentum analyst and pioneer in market structure, forecasts that current pullbacks in gold and silver will swiftly yield an explosive upward trajectory. Silver is targeted to surge between $300 and $500 per ounce, while gold is projected to climb well beyond $8,000, mirroring prior eightfold bull market cycles. A swift, engineered fake-out drop down toward $3,950 during Federal Reserve policy meetings could trigger a rapid vertical reversal that catches broader markets off guard. As central banks inevitably accelerate monetary expansion to cushion an unfolding government bond crisis, relentless M2 growth will drive capital out of fiat currencies directly into physical bullion. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
When you looked at the momentum charts, you say, wow, what a base. The only thing you need is to punch up through the top end of the base to get the buy signal. We're toying with those levels over the last few weeks, and they seem to stop right at our numbers. We put each weekend, we update our numbers. They come right up to our numbers and pause again. It wouldn't shock, and I kind of hope it does happen, that with the Fed meeting today, that something causes gold to spike to a lower low again. Now, its lows have been so far above 39.50. So let's go down and hit 39.50. To make a, quote, new low. Because I think that if you do that, you could get a compression situation where instead of this quietness we've had, you get this noisy spike that vertically turns around. Quite often, that's how markets will do it. You know, they won't end quietly. They'll end with a fake out. So I'm kind of hoping that we get some kind of negative today that's interpreted like, oh, the Fed's going to raise rates or the Fed's going to be tough. And we get that because I think we're very near that upturn. On the other side of that upturn, I think gold is going to go well past 8,000. Now, why 8,000? The prior bull moves in gold, since it was legalized, went from the 1976 corrective low, it was legalized in 75, had a drop to 103 in 76. From that low, you went to 850 by 1980. Eightfold move. Then you made a low, 2001 and 2, at about $260, $255. Next high was 1920, another eightfold move, different spans of time. Our low was 1,050 in 2015, the last major bear low. Eightfold move says 8,500 or so. JP Morgan came up with 9,200, I think. But we argue that one, getting there will be very rapid, but two, these other events that are fundamentally major, like the government bond crisis, will move to the fore instead of being hardly chatted about. And the whole public perception and government perception of what's going on and how dangerous it is will change all assumptions about what central banks are going to do. And there's only one thing they can do. They cannot let the house burn. Exactly. They have to print. They have to buy those bonds. And that means print the money, meaning accelerate the monetary growth. And we all know that that's what gold lives on. Gold as money has outpaced the degradation in the US dollar measured by the M2, the money supply, which money supply going back to 2000 to the present, so over a quarter of a century. How much has M2 gone up percent-wise compared to gold? Gold has outpaced it vastly. It's been a better place to be than the growth in the money supply. So it has saved you from the degradation in the money unit. S&P has matched the degradation in the money unit. I mean, it's gone up as much since 2000 as has the money supply, meaning it really hasn't made any real value, gained any value. It's held its own versus the degradation in the money unit. So from an investment point of view, which has done better, gold or the stock market? Most people would not know that the gold has vastly outperformed the stock market over an investment lifetime. And I think that's about to go crazy. The central banks create money flow, as they constantly do. Look at M2 charts, okay? That creates asset class movement and liquidity flows. Investors ultimately make that decision about, well, they printed the money, where are we going to put it? Well, they really went crazy back in 2008 and 9 because of the stock market debacle then and the failure of banks. And they printed. In fact, they kept interest rates at zero for about 10 of those 15 years since then. But the money supply growth accelerated, and investors decided to put it into the stock market. After all, the S&P had been cut in half. What the heck? It's cheap. Let's buy it. And they've been doing that for 15 years. But history shows that investor flows of liquidity created by central banks doesn't always stay in the same place. Investors ultimately get tired of a given asset and they'll shift to something else. We saw that back like in the late 70s when, they gave up on the stock market. It was a total wasteland for a decade. You couldn't make any money. In fact, it was most of the time was negative. But commodities and gold exploded big time during a global recession because investors decided, hey, they're creating the money flow. Where are we going to put it? I'm tired of the stock market. It's not working. Find some other place to go. Right now, we're in a very unique situation because not only do I think the stock market is topping, particularly the U.S. market, which is an extreme bubble, by the way. A lot of stock markets are not bubbles. This one is, more so than it's ever been in history, the U.S. stock market. It used to be an alternative would be what? The T-bond market. If you go back and look at the stock market from 2000 to 2002, the dot-com collapse, or 2007 to 2009, the mortgage crisis. T-bonds were a play. They worked as an alternative asset category. So did gold during that span of time. Those two places were the alternative places to be. And investors simply moved their money over there once they realized that's the place to be. I think that's what's going on now, is that we're getting the initial shaking of the market where smart money is saying, hey, I'm going to start to distribute out of this bloated category and move a little bit more into the alternatives. The big changes occurred, and we know it, because a lot of CIOs of major banks have said, hey, no longer 60-40 rule, stock market, bond market. It's now 60-20-20.
Yeah, Morgan Stanley
bonds.
Also advises.
Yeah, Morgan Stanley and others have followed him. Yes, that was half a dozen months ago. He was very wise in that
observation.
I think the percentages are a little low. That's okay. But at least he acknowledged that gold is a real asset. And I don't think the gold move is over. I think the pullback is intermediate, not long-term. And I think that what we're about to see is further toppling of the stock market. And once that becomes bleeding obvious to the average guy and to the central banks, the central banks will print, even though that's not a mandate, because some of the components of the stock market are mandates in effect, banks, et cetera. And we analyze the financial and the banking sector. Technically looks quite vulnerable. But gold is a place to be. And so I think things are changing in a big way. And it's an asset class shift. Public sentiment will shift and finally chase things that it should have chased a while ago.
Central banks have long driven destructive boom and bust financial cycles by relying on constant monetary expansion. Facing severe debt obligations or banking instability, monetary authorities possess only one remedy: aggressive money printing and debt monetization. Over the past quarter century, relentless M2 expansion has severely eroded the purchasing power of paper currency, while benchmark equity indices merely tracked this monetary debasement without producing true capital growth. Physical gold dramatically outperformed the stock market. Major institutional leaders are now recognizing this dynamic, abandoning traditional 60-40 portfolios in favor of real asset allocations such as 60-20-20. As an overextended equity market reaches its cyclical top and financial sector vulnerabilities deepen, central bank liquidity injections will no longer sustain paper assets. Consequently, massive capital flows are predicted to exit inflated equities and reallocate into tangible gold reserves to preserve wealth. Now, let's get back to the interview.
The gold and silver will ultimately become a panic point for the public where they will rush into it because it literally becomes the only place to be. Now, basic commodities will also come into play here. I think they're an investment grade situation. I don't think they're meteoric, but I think they're an investment grade place to be because they're vastly undervalued. And I think the money will move there. But what happens right now, we don't have extreme emotion in the markets, in the stock market, for example. Right now, anybody who has a retirement account at least is smiling, saying, well, my retirement account's up from a year ago. That's the only thing he's got to smile about. It's not his cost of living. It's not his mortgage. It's not the fact that he's past due on his credit cards like nobody's been since 2008, whatever. It's that his stock market's up. But if you take that away from him, you interject emotion into the public because then they have no sense of an anchor or something to grab onto. Then they're desperation. So you go from calm to emotion. Stock market will help precipitate that. The government bond situation will create even more panic. Because if that's not a safe place to be, then the whole world has been turned upside down. Meaning concepts that we've had for 100 plus years, institutions we've had like the central bank, Federal Reserve, and so forth, will come into question in terms of, gee, do those really work? Or are those creators of dysfunction? You look back at the history of the Fed, they create boom-bust cycles. Monetary expansion, stock market goes up, then suddenly you get excess, stock market breaks, the Fed panics again, prints more money. It's like a boom-bust cycle. And I think there's a growing awareness of that among academicians. But what will really bring it to the front is when you get into a crisis mode and markets hurt people. And that's when suddenly any talk about what's going to happen will go tabula rasa. I don't know, but I know a lot of concepts and institutions will probably be just simply puked out. They don't work. And therefore, to some extent, it's like it's a nuclear event. Mankind will be looking for alternatives. So what do we do now? One example would be Javier Milei in Argentina. He used to be the seventh biggest economy in the world, Argentina, back 50, 70 years ago. Okay, now they've become a third world country. Two political parties, like Democrats and Republicans, vied for power there for decades. They were both socialist in effect. They had a socialist economy. You had inflation. You had all kinds of pain on the part of the lower income people about rents, prices, even though they had, quote, rent controls, government controlling the rent market. Here comes a guy in there, and the young kids of today, not the older folks, the young kids said, it's not been pleasant life. We need something new. And no, they didn't understand that Javier Milei, who declared himself to be an anarcho-capitalist, not a libertarian, anarcho-capitalist, started tearing government down. And one of the things he tore down was the rent control of government. But this is, again, a situation where emotion takes over. People vote for him, not necessarily knowing the explicitness of his ideas, but knowing he's going to change things. We need to tear stuff down. And he started tearing it down. And when he got rid of the government control over rent prices collapsed. The average guy could afford rent. And I mean, it literally collapsed. Inflation's come down dramatically there because they had a fit. In other words, it takes pain to have a fit. I think that's about to happen globally, where enough discord will occur because of the pain that new ideas will move forward that people hadn't even thought of before. I understand also that many of the countries that the U.S. socialists and liberals admired over the decades, like Sweden, have begun to reverse their trend toward socialism and go more back toward free markets. Now, that's not a headline, but there's been an impulse to do so. And I'm not sure quite what the motivation is, but I understand it is ongoing. You know more about it than I do. But what if that happened globally and was provoked by a crisis-type situation, financial crisis, that isn't just here or there, but it's everywhere, especially Europe, especially U.S., Japan. That will provoke ripping the tablecloth off. And, let's find something new. And I'm not going to predict what that is, but I think that's the kind of event that could come quickly once certain markets start to implode. One, the bond market is on the edge of creating a panic. And two, if the stock market rolls over not much further than it is now, like another 7-8%, you're going to start to see real, more rapid degradation there in that asset, which will create the emotion. I expect it this year, I think probably in the third quarter, fourth quarter. We're in the third quarter, excuse me, especially noticeable as we get into the fourth quarter. And I think that's consider you as an investor have certain broad places to be. Let's call it stock market, government debt, commodities, and gold. Okay. Real estate's in question, by the way, right now, very much so. But if all of a sudden we know that bonds aren't working, and the stock market starts to fail, then what's your option? Especially if it is accompanied by pain. That's when gold can go ballistic, literally parabolic type action. And especially silver and the miners, I think, would do so more than gold. Our technical work argues that.
A sharp market breakdown rapidly shifts investor sentiment from passive optimism to intense financial panic. Millions of households currently derive confidence from inflated retirement accounts while overlooking rising living costs, heavy credit card debt, and burdensome mortgages. Should benchmark stock indices roll over by another 7 to 8%, that false sense of security will evaporate most visibly during the third and fourth quarters, triggering severe economic friction. When government bonds simultaneously fail as safe havens, public confidence in legacy institutions like the Federal Reserve will completely collapse. Systemic crises routinely compel nations to dismantle central planning and embrace free market alternatives, much like Argentina's elimination of government rent controls, which triggered an immediate crash in housing costs. In this environment of severe structural disruption, precious metals will serve as indispensable financial anchors. Gold is predicted to experience a rapid parabolic surge, while silver, mining equities, and deeply undervalued basic commodities are projected to outperform gold even further, as desperate global capital seeks refuge in tangible assets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.